If you've ever looked at a real estate deal and seen a number like 2.1 times and had absolutely no idea what that meant, you're not alone. Most investors skip right past it. They focus on the IRR, they focus on the cash on cash return, and they completely miss one of the most powerful and most honest numbers in the entire deal, the equity multiple. And here's the thing, once you understand what it actually means, you'll never look at real estate investment the same way again. In the next 8 minutes, I'm going to break it down completely. What it is, how to calculate it, how to use it to compare deals, and most importantly, how to spot when a deal looks great on paper, but actually isn't. No complicated formulas, no finance degrees required, just a clear, honest explanation that you can start using today. Let's go. First, let me be clear about who this is for. If you're a passive investor, someone who invests in real estate syndications, private funds, or any kind of private real estate deal, the equity multiple is one of the most important numbers you need to understand before you wire a single dollar. It's also for you if you're just getting started and trying to make sense of all the metrics that sponsors throw at you in a deal summary. Now, before we get into the mechanics, let me bust two myths that trip investors up all the time. Myth number one. The IRR tells me everything I need to know. No, not even close. The IRR, the internal rate of return, is a useful number, but it only tells you the rate at which your money grows per year. It doesn't tell you how much money you actually end up with. A deal with a 30% IRR that lasts 3 months might return you just 7.5% on your actual capital. That's not wealth building at all. That's a rounding error, essentially. Myth number two. A high return percentage means a great deal. Also not true. Percentages can be manipulated by changing the timeline. Equity multiple is much harder to fake because it's telling you something brutally simple. For every dollar you put in, how many dollars are you going to get back? That's it. That's the whole idea. Now here's the mechanism, the math that makes this so powerful. The equity multiple formula is simple. Total cash received divided by total cash invested. That's it. If you put in $100,000 and you get back $200,000 over the life of the deal, you guessed it, that's a 2 times equity multiple. You doubled your money. If you put in $100,000 and you get back $180,000, that's a 1.8 times equity multiple. And if you put in $100,000 and you only get back $90,000, that's a 0.9 equity multiple. And that means you lost money. Anything below 1 means you got back less than you put in. Anything above 1 means you made a profit. The higher the number, the more the money grew. Simple, powerful, and almost impossible to spin. Let me walk through exactly how to use the equity multiple, step by step, so you can apply this to any real estate deal you're evaluating. Step 1. Understand what goes into the total cash received. The equity multiple counts every dollar that comes back to you as an investor. That includes quarterly distributions, the cash flow you receive during the hold period. It includes your original capital returned at the sale, and it includes your share of the profits from its sale. Add that all up. That's your total cash received. Step 2. Know your total cash invested. This is straightforward. It's the amount you wired into the deal. If you invested $100,000, that's your number. Step 3, do the division. Total cash received divided by the total cash invested. That result, that's your equity multiple. Let me make this concrete with a real example. Say a syndication requires a 150 unit apartment complex. You invest $100,000 as a limited partner. The deal has a 5-year hold period. Over 5 years, you receive $8,000 per year in cash flow distributions. That's $40,000 total in distributions. At the end of the year 5, the property sells. You get your $100,000 back, plus your share of the profit from the sale. Let's say another $70,000. So your total cash received is $40,000 in distributions plus $100,000 of capital return plus $70,000 in profit. That equals $210,000. You divide $210,000 by your original $100,000 investment. That gives you an equity multiple of 2.1 times. You more than doubled your money. Step 4, compare it to the hold period. Here's where it gets really useful. The equity multiple alone doesn't tell you the whole story. You also need to know how long it took you to get there. A 2.1 times equity multiple over 5 years is very different from a 2.1 times equity multiple over 10 years. A simple way to think about it, divide the equity multiple by the number of years. A 2.1 times over 5 years gives you a ratio of 0.42 per year. And a 2.1 times over 10 years gives you a 0.21. The 5-year deal is clearly better. This is why equity multiple and hold period always need to be read together. Step 5, use it alongside the IRR, not instead of it. IRR tells you the annualized rate your money is growing. Equity multiple tells you the total amount you end up with. You need both. Here's a great way to think about it. IRR is like your car's speedometer. It tells you how fast you're going. Equity multiple is like your odometer. It tells you how far you actually travel. You can be going very fast for a very short time and not get very far. Or you can go at a steady pace for a long time and cover a lot of ground. According to research from multiple private equity real estate sources, investors who focus only on IRR often get misled by short duration deals that look impressive on paper but don't actually build wealth. A 30% IRR over 3 months is a 1.075 times equity multiple. That's barely a return at all. A well-executed multifamily syndication, by contrast, typically targets a 1.7 times to 2.2 times equity multiple over a 5-year hold. That's where real wealth gets built. Let me give you one more concrete example and then handle the concerns I know are in your head. Say you're comparing 2 deals side by side. Deal A has an IRR of 22% and an equity multiple of 1.6 times over 3 years. Deal B has an IRR of 16% and an equity multiple of 2 over 5 years, which is better. Most people see the 22% IRR and immediately say Deal A. But look at the equity multiple. Deal A returns 1.6 times your money. Deal B returns 2 times your money. If you invest, say, $100,000, Deal A gives you $160,000 back. Deal B, $200,000 back. Deal B puts an extra $40,000 in your pocket, even though its IRR is lower. And that's the power of the equity multiple. It cuts through all the noise and tells you exactly how much richer you actually got. Now, the macro backdrop matters here too. According to CBRE's latest data, annual multifamily investment volume in 2025 increased 9.1% to $161 billion. Vacancy nationally fell to 4.8% in Q1 of last year, the strongest first quarter absorption since the year 2000. Rent growth is expected to average 3.1% annually over the next 5 years. And that's the environment in which well-structured syndications are operating right now. And it's the environment that makes hitting a 1.8 to 2.2 equity multiple on a well-written, conservative, underwritten deal a realistic target. Now, let me address the concerns. Concern number 1, what if the equity multiple is projected, not guaranteed? Correct, it's always a projection. Sponsors model their expected returns based on assumptions about rent growth, expenses, and exit cap rates. The actual number can be higher or lower depending on market conditions and execution. This is why you vet the operator. Ask for their track record on deals they've already closed and exited, not just the ones they're currently managing. Closed deals don't lie. Numbers are numbers. Concern number 2, can sponsors manipulate the equity multiple? It's harder to manipulate than IRR, but not impossible. A sponsor can project a high equity multiple by assuming an unrealistically high sales price at exit. That's why you look at the exit cap rate assumption in the pro forma. If they're assuming the property will sell at a lower cap rate than it was bought, meaning a higher price, ask them to justify that assumption with current market data. Concern number 3, Is a 2 times equity multiple realistic? For a well-executed value-add multifamily deal over 5 years? Yes. Bigger pockets, community data, and private equity research consistently show that experienced operators in strong markets range in that 1.8 to 2.2 equity multiple range. Some deals even exceed that, and some fall short. The key is choosing operators with track records that you can verify and conservative underwriting. Here's what I want you to picture. 5 years from now, you've invested in, let's say, 2 carefully chosen syndications, each one at 100,000, each one targeting a 2 times equity multiple. At the end of year 5, you have 400,000. You're 200,000 back plus 200,000 in profit. You reinvest that 400,000 into the next round of deals, and over the following 5 years, if those deals also hit anywhere around 2 times, you now have 800,000. That's the compounding power of the equity multiple applied consistently over time. There's no tenants, no toilets, no midnight phone calls. You understand one simple number. You let it guide every investment decision you made. And that's not a fantasy, that's a strategy. And it's one that thousands of busy professionals, which includes really doctors such as myself, engineers, executives, are quietly using right now to build some serious long-term wealth in real estate. Now, if you want to go deeper on all of this, go to rei.com. There you can download 2 free ebooks that build exactly on what we covered today. And they're completely free. I wrote them. No strings attached. You'll also get instant access to our free 9-part passive investing masterclass. Inside that training, I walk you through the exact framework that a lot of investors use to evaluate deals, vet operators, and understand these metrics like equity multiple and IRR, and start to build a portfolio slowly over time. It's designed specifically for busy professionals. People who want conservative, intelligent, long-term passive income without becoming full-time landlords or property managers. This isn't a get-rich-quick thing. It's steady and disciplined. And if you want to keep learning, watch the next video where I'm going to go ahead and break down exactly what happens when you invest in a syndication from day one that you wire the actual funds to the day that you get your profit check. I'll see you there.